Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about MSC Industrial Direct Co. Inc. Quarterly Report. MSC Industrial Direct Co. Inc. offers a wide range of products and services to various industries. The company's product portfolio includes metalworking and MRO products such as cutting tools, abrasives, machining fluids, measuring instruments, and machinery hand and power tools. In addition to its extensive product offerings, MSC also provides various services including inventory management solutions, customer care centers, and e-commerce channels through its website. The company serves a diverse range of customers including individual machine shops, manufacturing companies, government agencies, and more. Some of the specific business areas that MSC operates in include metalworking products, MRO products, inventory management solutions, e-commerce services, customer care centers materials, handling products, electrical supplies, plumbing supplies, safety, and janitorial supplies overall. MSC Industrial Direct Co., Inc. is a leading distributor of metalworking and MRO products and services, serving various industries across the United States, Canada, Mexico, the UK, and internationally. MSC Industrial Direct Co., Inc. market capitalization of $5 billion is materially smaller than most of its industry peers of roughly $10 billion. MSC Industrial Direct Co., Inc. trades at a lower price-to-earnings ratio of 24 times and a lower price-to-book ratio of 3.67 times relative within the industry. This makes the stock valued slightly lower than its peers in the industry. This likely suggests that investors are less interested about the company, or it could be that the stock have not caught up to the industry valuation and should further be investigated. The company maintains a moderate leverage profile, with liabilities making up 43% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The company have a dividend yield of 3.83%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the extracted summaries. On the growth side, several key factors contribute to increased revenue. Sales optimization efforts and the implementation of a refreshed go-to-market strategy have been instrumental in driving growth. Additionally, diversification of the customer base, expansion of solutions and digital capabilities, and high-touch programs have all contributed to revenue increases. Furthermore, productivity improvements and reduced operating expenses as a percentage of net sales have also led to increased revenue. The company's focus on core customers and OEM fasteners has yielded positive results, while favorable third-party shipping rates have resulted in decreased freight expense. These factors collectively contribute to the growth of revenue. On the other hand, several factors have contributed to revenue decline: decrease in cash from operations, increase in restructuring costs, tariffs, inflationary pressures, sustained high interest rates, and increased fuel costs have all negatively impacted revenue. Geopolitical tensions in the region have also had a significant impact on public sector customers, leading to a decline in revenue. In terms of customer segments, core and other customers have seen significant growth, while national account customers have experienced minimal growth. Public sector customers have seen a decline in revenue due to federal government shutdowns and geopolitical tensions. Manufacturing customers have shown 2.7% growth, while non-manufacturing customers have experienced 3.5% growth. Geographically, the United States and Mexico, Canada, North America regions have remained stable. Net income and profit margins show improvement. The financial performance of a company has shown positive trends in terms of net income and profit margins. For the 13 weeks ended February 28, 2026, net income increased by 7.4%. This growth continued for the 26 weeks ended February 28, 2026, with an increase of 9.8% and then again 10% on page 6. The improvement in profit margins is also notable. The gross profit margin rose from 41% to 41.1%, while the income from operations margin increased from 7% to 7.1%. Notably, the net income margin saw a significant increase from 4.4% to 4.6%. The overall trend suggests that the company's financial performance is on an upward trajectory, with both net income and profit margins showing improvement over the specified periods. The financial performance of the company is a positive indicator. The net cash provided by operating activities has shown an increase from $123,809 in the 26 weeks ended February 28, 2026 to $156,334 in the same period last year. This significant growth demonstrates that the company is generating sufficient cash flow from its core operations. The company's financial situation has undergone significant changes over the past year. One notable trend is the increase in debt levels. The total debt has risen from $485,699 in 2025 to $511,750 in 2026, while long-term debt has increased from $168,831 to $194,517 during the same period. However, despite the rise in debt, interest expenses have actually decreased. In 2025, the company incurred $12,250 in interest expenses, but this figure dropped to $10,939 in 2026. This suggests that while the company's debt levels are increasing, it is able to manage its interest payments more effectively. Management is emphasizing the importance of maintaining momentum in the company's journey. This involves focusing on core customers and OEM fasteners while driving productivity improvements. To achieve this, they plan to leverage investments in advanced analytics to enhance supply chain performance and digital capabilities. The company aims to grow sales profitably by offering technical solutions that address complex customer challenges. Additionally, management is positioning the company as a mission-critical partner through strategic acquisitions and selective market expansion. They will also monitor economic conditions to assess potential impacts on customers and markets. Management expects favorable pricing actions due to tariff-driven product cost inflation, concerns to continue contributing to gross profit margin improvement. This suggests that the company is well-positioned to navigate current market challenges and capitalize on opportunities for growth. The company has made significant investments through acquisitions in recent periods. One notable example is the acquisition of W.M.F. Hearst Co., LLC for $8.2 million during the 26 weeks ended February 28, 2026. This strategic move demonstrates the company's commitment to growth and expansion. In terms of divestitures, there have been no mentions in the provided summaries. The company appears to be focused on acquiring new assets rather than selling off existing ones. The company has a history of rewarding its shareholders through various means. One way it does this is by paying dividends. In the given period, the company paid aggregate regular cash dividends of $97,175 for the 26-week period ended February 28, 2026. This amount translates to $1.74 per share. In addition to paying dividends, the company has also been actively buying back its shares. As part of a share repurchase plan authorized by its board of directors, the company purchased up to 5,000 shares of Class A common stock. Specifically, it repurchased 160,000 shares of MSC's Class A common stock for $13.7 million as of February 28, 2026. The company's efforts to return value to its shareholders are evident in these actions. By paying dividends and buying back shares, the company demonstrates its commitment to rewarding its investors and enhancing their returns on investment. There are concerns about inventory buildup, but not necessarily supply chain disruptions. Inventory levels have increased significantly as of February 28, 2026, compared to previous periods. This buildup is a concern, but it does not necessarily indicate any major issues with the supply chain. The only mention related to supply chain challenges is on page 27, where inventory management countermeasures are mentioned in response to tariffs. However, this implies that there may be some level of disruption or challenge, but it is not explicitly stated as a concern. On the other hand, page 19 highlights industry-leading inventory management and supply chain solutions, suggesting that the company has measures in place to mitigate any potential disruptions. That concludes the financial summary for MSC Industrial Direct Co. Inc. Feel free to comment below and I will be happy to answer them when possible.